Ladies and gentlemen, good afternoon and welcome back to the final session of the EPRA conference that promises to be a really exciting one. Our keynote speaker this afternoon is Brendan Wallace. Some of you will know about Brendan's many successes over the past period of time. He started his career at Goldman Sachs in the real estate, hospitality and gaming group before joining Blackstone Group's real estate private equity practices. But he's known today as the co-founder and managing partner of Fifth Wall, where he guides the firm's overall strategic vision. Prior to joining Fifth Wall, Brendan was very much identified and worked with a series of tech startup companies, being both an investor himself and a venturer in various aspects, including a number of firms whose names you can see in the biography attached. Brendan's going to talk to us today about how industry consortia can work together to help propel real estate forward using technology and innovation, and how this will contribute to tackling, in particular, the embedded carbon opportunities and challenges and renovation. So it's a great pleasure to hear from Brendan. I've been looking forward to meeting him for some time. So Brendan, welcome to the EPRA conference. We're looking forward to hearing from you. The floor is yours.
Thank you, Greg. Thrilled to be here and looking forward to telling you, I think, a few things which touch on something Greg previewed. One is just how we built Fifth Wall and what Fifth Wall is, and how kind of building real estate industry consortiums enabled us to build, I think, a really unique model to propel the industry forward with respect to technology and innovation. And the second is how that same industry consortium might be applied to help the real estate industry with one of its, I think, near-term, but really existential crises, which is the imperative to decarbonize and to invest an enormous amount into existing and new real estate assets to reduce the carbon footprint of real estate to zero. So I thought I'd talk about both. Why don't I just start with kind of a brief background of just who Fifth Wall is. So Fifth Wall is today the largest, the most active investor in real estate technology. We manage $2.6 billion across a number of different investment vehicles, all venture capital funds. What really makes our model unique amongst kind of venture capital funds is that about half of that capital comes from the largest owners and operators and developers of real estate globally. And as you can imagine, those owners of real estate are in turn the largest customers of the Proptech businesses that we invest in. And we actually really pioneered this model back in 2016. Back in 2016, I know it feels like a long time ago, there was no such thing as Proptech. Proptech did not exist. In fact, we went out and tried to raise our first fund, and most people asked us, what is real estate tech? Is that even a thing? Why would real estate companies ever use technology? And our response was, look, real estate is 13% of the US economy. It's the largest asset class, it's the largest lending category. And yet I think everyone knows it is clearly one of the least technologized. It almost feels like, in 2016, it felt like the real estate industry had slept through 2 decades worth of innovation, and it was just waking up to, how to innovate and how to adopt technology. The challenge was that there were a lot of real estate firms that wanted to embrace technology, but predictably, it's very hard for a real estate organization to engage with tech and venture capital. So what we did is we kind of pioneered a model where large owners could invest in our fund. Fifth Wall would collaborate with them. They would collaborate with each other as part of this consortium that Greg mentioned. And by virtue of that, we would have these intellectual economies of scale and intellectual synergies to be able to kind of propel all of those industry corporates that are in our consortium forward, expose them to the best technologies, structure partnerships, enhance revenue, cut costs, and just, add efficiency to their business through technology. That was the promise, and I think that was ultimately what we pioneered in our first fund. So the platform today has grown significantly. We've raised now 3 funds in North America. We've raised a fund in Europe. We've most recently raised a climate tech fund, which I'll talk about, but across the entire platform, Fifth Wall today has 70 strategic investors. So it's groups that you're probably familiar with in the US, like Host Hotels and Marriott and Cushman & Wakefield and CBRE in the brokerage space, and Related and Hines and Hudson Pacific and Equity Residential and kind of the commercial space. But I'd also note that we brought in some of the largest international owners now. We have 70 corporates across 15 countries in every major subsector. So In Europe, it's groups like British Land in the UK, Segro in the UK. Jacina has been a fantastic investor for Fifth Wall from France. Merlin in Spain, BNP in France. And that consortium is obviously growing within the European ecosystem. And then in Asia, it's groups like Mitsubishi Estate, the largest owner in Japan, China Vanke, the largest developer in China, Keppel and GIC and Temasek in Singapore. And so we've been able to foster this kind of cross-sector, highly international consortium of owners who are now embracing technology. And I think one of the really exciting things for us is that it's also fostered a lot of idea sharing between those strategic LPs, meaning when we're looking at any particular technology theme, whether it's construction tech or energy efficiency, we're able to evaluate that on behalf of one strategic LP, but share those insights and those learnings in a way where we can benefit other real estate corporates that are struggling with the same pain points. And so Fifth Wall today, we have offices now all over the world, including in Europe now in London. We've built, I think, this very unique model of investing in technology for the built world, Proptech, but doing so in collaboration with owners and operators and developers of real estate who invest in our funds, become part of our consortium, and get access to all of that new technology. So I wanted to present that first, just to kind of set the table of who Fifth Wall is, what we've built, and kind of what we do. But I want to bring it to, I think, a more relevant, but frankly, existential question for the real estate industry that is going to confront over the next 2 decades, which is the climate crisis. So most people are kind of shocked to learn the real estate industry's contributions to the climate crisis. If you asked most people that are not familiar with sustainability or the climate crisis or decarbonization, their reflexive answer would be that the automotive industry or the shipping industry or the energy industry are the most contributive from a CO2 perspective to climate change. That's actually wrong. It's actually the building sector that is the single most contributive. So real estate is responsible for 40% of global energy consumption, 40% of CO2 emissions, and 40% of all raw materials consumption. So it actually is kind of staggering. It's more than transportation. It's more than any other industry in the US or globally. And there's paired with that this kind of systemic problem of that, and I'll talk more about this, other industries have taken steps, right? They have had leaders emerge. So in the automotive industry, you've had Elon Musk and Tesla emerge, where they've invested enormous amounts in decarbonizing an otherwise highly inefficient industry. The real estate industry has not really embraced that. So in aggregate, the real estate industry over the last decade has invested, and this is a true stat, less than $100 million into tech to decarbonize. So the real estate industry is kind of woefully behind these other industries, despite its outsized contribution to climate change. And so what I wanted to talk about is how can we kind of unpack that? What does that mean for, obviously, the owners in the real estate world today? And then I can talk a little bit about a solution that I think does touch on Fifth Wall's unique consortium model. So the first thing that oftentimes real estate owners say is, we have that solved, right? We have kind of the green building councils, we have Energy Star, we have LEED standards, we have alternative energy. Aren't we kind of close to getting to carbon zero for real estate assets? And the sad reality is that no, we're actually pretty far today. So even if you implemented today in an existing asset, all of the best solutions, right? Forgetting ROI, forgetting payback period, you were to implement every single solution, the best in class solutions to reduce the energy efficiency load of an asset, you'd only get about halfway there. That's shocking, right? Like today, even with all the best technology deployed at a given asset, you can only get about halfway to true operational carbon zero. So there's a big delta, and that delta is going to be closed by funding to climate tech, right? That is ultimately going to, enhance the commercialization, enhance the payback periods, and enhance the usability of new technologies that can close that 50% gap. On the other hand, a lot of real estate owners are relying on offsets. And so there are kind of, I think, very aspirational and I think grand and important pledges that we've seen from the real estate industry that have committed to being carbon zero. Most of them, unfortunately, are premised on the use of carbon offsets. which is, they're on the one hand, I think a great way to kind of bridge this twilight period before we have the technology to truly create carbon zero real estate. But they're kind of like saying you lost weight because you put 1 foot on the floor, right? They're not really reducing the actual CO2 emissions of real estate assets. They're just offsetting them in a kind of unique accounting way. And frankly, that accounting has come under a lot of criticism lately. And I'll talk more about how the public and how regulators have reacted to those offsets. But what's important also for the real estate industry is that, unlike 5 years ago, the major stakeholders of the real estate industry are now focused precisely on this issue. And that is a real shift. We started Fifth Wall in 2016. We weren't hearing an imperative from our corporate partners that we needed to focus on climate tech. Today we are, and that is a real change. And I think it starts with consumers. That is one of the constituents. I mean, in 2019, there was the climate strike that happened in 150 countries. 7.6 million people participated globally. It was overwhelmingly powerful in Europe in particular. And I would expect that consumers continue to take, positive action to try and drive regulators and drive industry to decarbonize. The second is tenants. And you can kind of think of tenants, I think, and consumers as one and the same, which is tenants are honestly just refusing to inhabit inefficient buildings. They are favoring lower carbon footprint real estate assets. And so there is a supply-demand dynamic that is at work in the market. Right alongside that, a lot of large corporates that are huge consumers of space have made very public commitments to decarbonize. So for example, Amazon has very publicly committed to decarbonizing. I think what most people are surprised to realize is that, one of the biggest, like when Amazon commits to decarbonizing, they're committing their entire supply chain to decarbonizing as well. And one of the biggest suppliers to the real estate industry, to Amazon, the real estate industry, in the form of data centers and industrial warehouses and offices and now retail stores. So real estate as a supplier to major tenants like Unilever, Amazon, Google, Microsoft, JetBlue, these large firms that have committed to carbon zero, they're going to have to decarbonize simply as a supplier to them. Right alongside that, many of those firms have committed enormous amounts of money to decarbonizing and to investing into climate tech to do so. And I'll talk more about how that contrasts with that $100 million number from the real estate industry. The other component and the other stakeholder that is particularly focused on this is regulators. I think in Europe, you've really been at the vanguard from a regulatory perspective around, promoting energy efficient real estate assets. The US, I think, has been behind. Obviously, the 4 years under the Trump administration were probably regressive from an environmental perspective. The US has now re-entered the Paris Agreement. But even frankly, when the US was withdrawn from the Paris Agreement, there were actually a number of cities that enacted local regulation that put the US right back in it. So there was Local Law 97 in New York, which was a carbon neutrality law. There's carbon fines contemplated in the city of Los Angeles. 407 mayors in the US have said that they will uphold the Paris Agreement. So the reality is carbon fines, carbon taxation are coming to the real estate industry. It's coming in Europe. It's already come in Europe to some extent. It's coming very, very fast in the US. And the challenge with real estate is that, unlike other industries, you can't move a building. So if I don't like the local regulation, in New York City, and I'm the owner of the Empire State Building, I can't move that to Mexico. I can't move that to Arizona because of more favorable regulation. So the real estate industry is inherently exposed to local and federal regulators. And the last constituent, and I think probably everyone realizes the most important for the real estate industry, is investors. Simply put, in 10 years, if you are not investing in climate tech, if you are not actively decarbonizing, you're not going to get money. Real estate is a cost of capital driven business, and some of the largest equity and debt allocators to the real estate industry have very publicly said that they will preferentially deploy capital to low or no carbon footprint real estate. Today, that's a positive trend. I think that's very quickly going to shift into we are simply not allocating capital to inefficient real estate. And that trend, I think, is a real driver. And I think that is probably largely to account for the new interest that we're seeing from the real estate industry in climate tech. And lastly, obviously, insurers, right? As you can imagine, costs of insuring assets and the climate resiliency of real estate assets has been going down as a number of both commercial and residential assets are more and more exposed to extreme climate events, the premiums are going up. And so certain real estate assets are going to be, functionally obsolescent by virtue of being functionally uninsurable. And that is a trend that is inevitably coming to the industry. So there's a unique way in which, the climate crisis is an existential issue for the real estate industry. And I don't think the real estate industry has wanted to grapple with it historically, but I think it has to now. And I think the reason that this is important in real estate is that this is a long-term industry, right? If you're buying a real estate asset today, you typically have a 10-year hold period. You're signing 10-year leases. You're signing 10-year investor agreements. So real estate definitionally today is within the window of where those firms that don't take a kind of front-footed posture on decarbonizing, their assets are going to be impaired. And I think that tenants and capital markets and regulators are coming. And I think that now is this kind of unique moment in time where the real estate industry can take some positive steps, correct for the sins of the past, and I think kind of reposition the whole industry. But it's estimated that it is going to cost for the global real estate industry $18 trillion to decarbonize. So to put that in perspective, that is, 1 year of GDP in the US. So the whole world, the whole real estate industry is going to have to invest 1 US GDP in decarbonizing over the next 2 decades. It's going to have to invest 12 New York cities of real estate in decarbonizing. That's an enormous amount of Capex. And I think what's interesting is that if you look today at Capex as a percent of NOI for most real estate assets, it's historically gone down. The trend line is actually down. Most real estate owners are investing less into assets than they ever have before. But as a function of needing to decarbonize, that percentage is going to grow. And in some years, I think over the next couple of decades, it's going to actually be close to 50 to 75% of NOI to actually achieve the carbon neutrality standards that most cities, most regulators, most tenants are going to demand. So real estate is going to become a Capex and investment industry to an extent it never has historically, simply by virtue of this new imperative to decarbonize. I think what's also important to realize is that this provides, I think, a unique opportunity for real estate organizations that kind of attack this from their front foot as opposed to their back foot. Just take the automotive industry. Look at the stocks of Ford and GM and Fiat and Honda and Toyota and compare them to Tesla. And there is a fundamental difference. One of those organizations invested massively in the technology to build a differential advantage around building electric cars. And capital markets have rewarded it overwhelmingly, right? The stock price and the enterprise value of Tesla exceeds all of those companies I just mentioned combined. Whereas back in 2017, Tesla was less valuable than any one of them. The same thing may happen in real estate. And I think that's what's shocking for real estate industry insiders to understand is that real estate has inherently been a highly granular industry, right? There's not been huge concentration of ownership in the real estate world. Even the hotel industry, where it's probably most concentrated, still has actually a relatively granular structure to it. But it very well may happen that those real estate firms that become the most adept, the most skillful at decarbonizing and understanding the technology that can lead to more efficient assets, they become the aggregators that roll up the space. This is happening in every other industry. Real estate is late to the game, but I would be shocked if it doesn't happen. And it probably will happen because if Capex as a percent of NOI goes up, it will favor those organizations that can most efficiently deploy that Capex towards a carbon zero future. And I think that represents a really unique opportunity. And I want to make sure, Greg, that I give you enough time for questions. So I want to bring it to kind of a conclusion, which is, why is right now the time to do something, and what is that thing to do? Right now, I think is absolutely the time to do something. I think we are in this twilight before real estate is thrust into the center of a spotlight around the climate change debate that it probably never wanted to inhabit, but it will for the next 2 decades. There is just, I think, no way around that. And I think anyone in the real estate industry needs to prepare themselves for that. The real estate industry also needs to prepare itself for enormous amounts of Capex. to spend into assets to decarbonize. However, the real estate industry has a fundamental problem in spending that CapEx to decarbonize, which is today, I don't think the real estate industry invests enough into the technology, the climate tech, that can actually close that 50% operational carbon gap that I mentioned at the outset. Meaning, without investing in that technology, the carbon sequestering concrete, the energy efficiency systems, the alternative energy on site, all of that, the real estate industry won't learn about those new innovations until it's too late. And so I think this presents a problem that harks back to something you started in introducing me, Greg, which is where a consortium can be valuable. My view is that the real estate industry should come together, and that this is a collective action problem. And the real estate industry should, as a whole, come together, contribute capital into, in this case, a fund that we have proposed that will invest into the climate tech that will benefit all real estate owners and expose those real estate organizations to the solutions that can actually effectively help them decarbonize much earlier than they would otherwise get exposure by virtue of having a very significant pool of capital investing into the very technology to decarbonize the built environment and kind of new, what I would call like sustainability focused prop tech investments. And so today, that is what Fifth Wall is doing. We are building, I think, the largest ever consortium of sustainability forward real estate owners who want to invest in the future of the industry by virtue of pooling their capital and investing that into the climate tech that they know is critical to helping them close that 50% operational carbon gap. And I think many of them know is critical to allowing them to differentiate themselves in a market where, you know, Capex spending on decarbonization is going to grow dramatically, and they want to be the best and the most efficient at it. And so again, we kind of ended up a little bit where we started, which is that, you know, Fifth Wall has built our firm on an industry consortium model. We believe that model solves big collective action problems. I think it did absolutely when we launched around Proptech. And I think, again, it presents a similar opportunity to solve a problem around decarbonization for the real estate industry, which I do believe is its existential challenge over the next 2 decades.
Brendan, absolutely fantastic. And it's great to have a chance now to have a chat with you about all of this. You've stimulated a lot of remarks in the chat, and Mecca, who's the chair of EPRA, says hello, pleased to see you again. And then I want to pick up 2 or 3 core questions. So it seems to me that right at the end of your remarks, you began to say that what climate tech is kind of next generation prop tech, or it's prop tech with a sustainability purpose. Could you just unpack that? What do you mean by climate tech exactly? And just give us a few examples so that people have really got it in their minds.
Sure. It's a great question because, like prop tech, it's inherently nebulous. And so the way I think about it is it doesn't even have to be technology. The term prop tech is not always technology, right? And I think that's a bit of a misnomer. But let's just talk about climate tech. So climate tech, I think, represents anything, any technology system that can reduce the energy consumption of an asset while maintaining its existing tenancy, right? So just anything that reduces the energy consumption of an asset. Now, that can be smart building technology, that can be a building management solution, that can be alternative energy on site, that can be smart industrial IoT at the asset, but anything that reduces its energy consumption. Number 2, it's energy itself. Real estate assets are going to have to become power plants. There's no 2 ways about it. The real estate industry has a huge advantage, which is it occupies a lot of space. We now have renewable energy that is capable of harvesting energy from space, right, from renewable resources. So real estate assets are going to have to become power plants. And that largely means, to put that very simply, solar, right, is going to become a source of energy for a significant amount of real estate assets, along with other sources like geothermal, and real estate assets are going to have to store that energy on site. There is a lot of hardware and software that goes into making that a reality, turning a real estate asset, which is dumb today, into a smart power plant that is actually potentially self-sufficient, yet at the same time connected to the grid in the future. The last major bucket, Greg, is materials tech. So a huge portion of the problem here is actually embodied carbon, meaning when you build an asset, it costs an enormous amount to build the asset, as every real estate owner knows. But honestly, even all those costs that real estate owners are very familiar with, they don't internalize the externality of all the embodied carbon that it took to ship that steel to that location, raise it vertically, fill it with concrete, put in the glass. That costs an enormous amount of carbon. That is what's called embodied carbon. For new real estate assets, and frankly, for some retrofitted assets, there are new solutions that sequester carbon. So everything from heat retentive glass to carbon sequestering concrete to, new drywall solutions that can actually suck carbon out of the environment. All of those are going to be critical for real estate owners to get exposure to. So the three buckets, to simplify it, like energy efficiency for the asset, turning buildings into power plant, using more efficient materials.
Very, very clear, Brendan. And thank you very much for taking the time to talk us through that. And I think everybody will have understood. Now, a second part of the question that was asked was whether you're concerned about something that the questioner calls whitewashing, which is where companies, as it were, leave behind buildings with all of the embedded carbon that are in them and just go for greenfield sites where they can embed new technology and possibly be more progressive. Is there a problem here of us trying to, as it were, leave behind our dirty secrets? And is that something you're concerned about?
Absolutely. I think everyone should be concerned about it. And I don't think it's just a real estate problem. I think regulators should be concerned about this as well. There is a reality that there is functional obsolescence coming to real estate assets in ways we never contemplated when we built them. And I say we, I mean, collectively, the real estate industry over the last, because it's Europe, I have to say, few hundred years, right? Like real estate assets are hundreds of years old. One, we never knew about climate change when we built most of these assets. Now we do. And so the energy efficiency is something that needs to be taken into account when measuring a building's functional obsolescence. Right alongside that, there's actually climate and locational obsolescence. It's very possible that a number of cities that we deem today desirable and inhabitable are no longer going to be so by virtue of insurance premiums becoming simply impossible to reconcile and actually maintain for an asset, or because of just extreme climate events that become highly destructive. I think as a function of those two things, regulators need to think about how to provide incentives to real estate owners, not just to build new stuff, which is great and we should be doing, but to incentivize the retrofitting of stuff that already is built. And, I think about, honestly, because you brought up Mecca, I think what Decina has done with existing building stock, like multi-hundred-year-old assets in Paris, where these assets were built before knowing what CO2 was, but to bring them to future energy efficiency levels while still maintaining, tenancy and vibrancy in Paris is a real challenge. And I think that incentives should be provided from regulators to say, look, we want to encourage not just new development, not just the La Defenses in Paris. We want to encourage the existing infrastructure, the existing streetscapes to be decarbonized. And we understand it might be more costly to do so, but we have a social or public imperative to do that. I think it's a very challenging but important issue for regulators to get right. Otherwise, exactly as the questioner mentioned, we will have functional obsolescence.
Yeah, absolutely. Thank you so much. Now, I want to come on in a minute to talk to you about the consortium approach and the leadership agenda that you began to sketch out in your remarks. But just before we go there, can we just pause for a moment and talk about the insurance industry? Because you've mentioned them once or twice, and to the kind of the untrained eye, the obvious comment may be, why didn't insurers get hold of this issue about the interaction between real estate and climate change much sooner? And are they becoming more active now, either as investors or as, of course, market players that set price mechanisms around future risks? What's your perception of how far the insurance industry is embracing the agenda you've been talking about?
I don't think anybody, including the insurance industry, realized how much of an existential threat climate change is. And I don't think that was the case until the last 5 years. So even though the insurance industry is in the business of trying to predict very long dated, high risk kind of actuarial events, I don't think they got this right. I think they're starting to get it right today. And I think what that's doing is it's having this effect of, taking something that wasn't a huge cost for the real estate industry, insurance, and making it a very high cost for the real estate industry. And I would say it's going to be a very high cost for probably two reasons. One is if you just happen to be located in a locale where there is enormous climate risk, there's almost nothing you can do. And I think, Greg, that is where we run into kind of some of the big social and public policy questions around, city and asset abandonment and kind of this functional obsolescence question. But I think also for other real estate owners, real estate assets that don't build in climate resiliency and aren't making investments in the future are going to be uninsurable. Who's going to want to insure an asset that no tenant wants to occupy? Even insurance companies won't do that. So there is a free market mechanism that I do think is also propelling the real estate industry to decarbonize. And I think the insurance industry is a small but growing part of it. But candidly, the insurance industry wasn't any better than any other institutions. Federal governments, local governments, private markets, the UN, no one got it right. And I don't think it's actually that instructive or useful to point fingers at them for kind of getting it wrong historically. All that matters is what we do now. But I think, no, they did not get it right historically.
And are they participating as investors in the sort of climate tech funds that you've been talking about?
Not yet, but honestly, they should. I think that no one has a bigger imperative to, want to reduce the existential climate risk to real estate assets globally than the insurance and the reinsurance industry. Just risk to real estate assets is on the rise. It's everywhere. We used to think about it as these kind of big, almost geological tectonic events like earthquakes, right? And those were kind of random. Now we know actually they are part of a very clear trend of increasing temperatures globally that very likely will go parabolic or has currently. And as it does, it produces parabolic risk increases in assets, right? An impairment of value to assets. So the insurance industry should be front and center on this. They haven't been yet. I'm optimistic that they will be.
Great, thank you very much. Now, in a minute, we'll come on to talk about the consortium approach, but let's just pick up on some leadership issues that you mentioned in your remarks. And I was very struck by what you said about Tesla and the investment in the new technology paradigms, and also what you said about Amazon, and if you like, what we call the scope 3 aspect of decarbonization, really having very strong policies around suppliers and value chains and everything else. So in the real estate industry, what does leadership look like on those sorts of issues? Do you see individual companies, individual leaders within the real estate sector beginning to behave in those ways?
Yes, we are. I think we are starting to see it. And I think that what's important, Greg, is to think about why are we starting to see it now? And I think there's really two things that are driving it. One is, I think, altruism, and I think that should be applauded, right? Investing into the technology to decarbonize the real estate industry, to reduce the carbon footprint of the whole asset class is really important. And I think a lot of the real estate owners that have invested in our climate tech fund care about that. They care about embracing this mantle of social responsibility for the whole industry. And I think that is fantastic. But I also think people don't talk enough about the non-altruistic imperative to do this, which is it's just really good business right now. And there was a report from Morgan Stanley, which estimated that globally, about 3 trillion to 10 trillion is going to be added to companies' EBIT that figure out how to successfully decarbonize. Meaning the ability to be a fantastic decarbonizer in any industry is going to increase profits long-term. Tesla is a prime example of this, right? Tesla invested an enormous amount in building pioneering models of how you build electric cars and deliver them to consumers at scale. The same thing is happening across every industry, from electric ships to electric planes to, solar and kind of alternative energy, and how old fossil fuel focused energy companies are now converting themselves into sustainable energy solutions and kind of sustainable energy businesses. The real estate industry hasn't had this yet, but it will. Meaning there's going to be a Tesla of the office industry. There's going to be a Tesla of the home building industry. And frankly, I think profits, exactly as this Morgan Stanley report that we can probably share with you after this suggests, are going to overwhelmingly favor those firms. And that, I think, is a total departure for real estate, where real estate is this industry which has inherently always been high margin. And it didn't matter if you were the second best operator or the third best operator or the 100th best operator, your margins weren't that different. But in a world where you're investing a really, really high percentage of your profits into Capex, that may no longer be the case. And actually, instead, only a few firms that are truly exceptional at understanding technological differentiation around decarbonization and are willing to make really long-term, long-dated bets in climate tech and decarbonization, only those firms are going to concentrate all of the profits. And by virtue of that, they're going to become larger and larger owners within the industry. So exactly what happened in other industries like automotive, I do think is going to start to happen in real estate. And so there's a clear profit incentive for like really forward-looking, long-term minded real estate CEOs to say, why don't I figure out how to become the best at this? And to the extent I do, maybe I will simply concentrate more ownership than I own today of whatever my asset class or geography that I focus on is.
So this is an absolute paradigm shift that you're describing here. And you also, meshed with your earlier remarks about all of this being a complete existential threat, not just to the industry, but its business models. I think you've made the point very, very clearly. Now, Brendan, coming on to your proposition, which is that, the consortium that you are building, and in a sense, you're inviting more people into, why don't you say just a little bit more, please, about, not so much the financial underpinnings of it, but how will you make sure that this consortium does indeed pursue the best technologies in the interest of everyone, given the winner takes all dynamics you've just described? And how do you prevent it, as it were, simply having large numbers of free riders who feed off the technology afterwards, but don't pay for it up front?
Great question. Something I've thought a lot about, Greg, as actually the operator of this consortium. The way you solve the last problem, how do you prevent free riders? So how do you prevent people from not really contributing to the fund, but yet, embracing all of its technologies? One, you don't let them invest a small amount. The real estate industry has been plagued historically by really small investments into climate tech. As I mentioned, over the entire last decade, the entire US real estate industry as a whole invested 94 million into climate tech. It's nothing, right? It's like half a parking garage in New York, right? It's just a de minimis amount of capital. It's negligible. So one is, I think you have to change the incrementation of it, meaning to participate into this consortium, you have to invest a meaningful amount of money. Here's the problem, I think, with real estate, though, is that, in other industries, for example, Amazon announced a $3 billion climate tech fund because they're Amazon. They're a $1 trillion company. They can afford to do that. In the real estate world, no one can afford to do that, right? I'm not going to wake up tomorrow and read a headline that some real estate company has announced a $3 billion climate tech fund. It simply won't happen. There's a granularity to enterprise value, size, and scale in the real estate industry that just preclude that. So I think what the opportunity is, one, you have to have a high increment, meaning that to be part of the Fifth Wall Climate Tech Consortium, you need to invest a significant amount of money. Now, it doesn't need to be so significant that it materially impacts the company's finances, but it probably needs to be in the tens of millions of dollars to do so. So in our fund, we proposed 25 million. So 25 million US dollars buys you a seat at the table. So meaningful, but not insurmountable for most companies. The second thing is, you asked this question around, if we're sharing that technology with all of the members of the consortium, do they kind of lack differentiation, or who gets the competitive advantage? And the short answer is, that's not for me to decide. That's for the market to decide. I want to make sure that if you are a real estate investor and you invest in Fifth Wall's Climate Tech Fund, you get exposure to the leading best solutions to decarbonize the industry. What you do with them, how you adopt them, how you deploy them, is ultimately up to those real estate owners. What I want to ensure is that you get access to them. And the problem that has always plagued real estate companies, and by the way, Greg, it plagued it in Proptech as well, is that they don't have enough money to be that influential in tech ecosystems. So whenever real estate corporates start their own venture funds, like I think there's been some groups in Europe that have tried this. I think Landsec has tried it. In the US, Simon has tried it. The groups have tried to do this, but the problem is they're able to invest like $50 million. And in today's venture capital markets, that's just not enough money to be influential and to get access to the best technologies. That's like bringing a stick to a gunfight, right? Like you need to have enormous amounts of capital. And the only way to do that, I believe, in the real estate industry is through aggregation, through having a consortium where, to your first point, there's high increment to participate in it. You show the best technologies to everyone. But Fifth Wall's climate tech fund, my sense is it'll probably be north of $1 billion. It's going to be one of the largest pools of capital focused on climate tech inherently, and certainly the only one focused on built world climate tech. And I think that's just obviously superior than an individual firm trying to go out and source solutions on their own off their balance sheet.
Great, Brendan, very, very clear once again. And what's the deadline for joining the consortium? Now is the consortium. We actually just announced the first 5 members of the consortium actually on Monday. So we announced that Ivanhoe Cambridge, Kimco, Equity Residential, Hudson Pacific, and Invitation Homes, now all US owners, have committed in those quantums to that vehicle. I expect that over the next probably 6 months, every month we'll be announcing new names that will be part of this consortium, and the pool of capital will be growing. There's no like hard deadline. Like we want people to participate, and it's kind of a question of when do you prevent free riding, right? At what point is too late? And I think it's probably sometime between 6 months and 12 months is when we would ultimately stop allowing real estate corporates to participate in this consortium. Great, Brendan, very, very clear. And in your last remarks, you made, I think, the point brilliantly that no real estate company is big enough on its own to be sufficiently influential in the tech ecosystems that they can go it alone. And therefore, your consortium approach or your joint venture approach is the way to do it. Brendan, I think we're going to leave it there. It's been a great pleasure to speak to you. I've really enjoyed listening to your brilliant creative solutions and your commitment to this agenda. So on behalf of EPRA, thank you very much indeed for joining us today.
Thank you, Greg. It's been a pleasure.
I look forward to the next opportunity. Now, ladies and gentlemen, that's going to conclude our conference for today as we give Brendan a virtual round of applause, as it were. Looking forward to the opportunity to see you at another EPRA event soon. And for the EPRA members here, of course, you'll know that there are other events tomorrow. We hope that the conference will be back in person next year. But let me say on behalf of all of us, thank you very much to our delegates. Thank you again to our sponsors. Thank you to the production team. Thank you to all of our speakers, including, of course, Brendan Wallace, excuse me, Brendan. Thank you so much and goodbye.